Thank you for joining me today. I'm Carol Florman, a policy fellow with Cancer Care. This is the first of a two-part series about health insurance coverage and ways that insurance companies may limit your access to care. The health insurance industry is very complicated and getting more so every year. There are lots of different players, lots of words you need to understand, as well as policies and practices that insurance companies and their partners use that can delay or deny you the care you need. We hope that by knowing more about how health insurance works, you will better understand how to access your benefits, protect yourself from costly surprises, and advocate for yourself when necessary. In this webinar, we will introduce you to the various types of companies that are involved in your health insurance, explain the key terms used by insurance companies, and introduce utilization management, an umbrella term for the policies that insurance companies use to reduce the use of healthcare services and costs to them. More than half of Americans get their health insurance through their employer. If you do, then your health insurance is employer-based. Your human resources department is likely the place that will manage the relationship between your health insurer, your company, and employees. If you have problems with your health insurance, you should talk to your human resources people and let them know. Other types of coverage include Affordable Care Act plans that you sign up through an ACA marketplace during open season, Medicaid, which is provided by states for low-income residents, Medicare, which is federal health insurance for people over 65, and TRICARE, which is available to veterans. Your employer contracts with a health insurance company to provide healthcare benefits for employees. The health insurance plan determines what services are covered, what your costs are to receive those services, and which doctors, hospitals, labs, and other providers are part of their coverage network. Your insurance card provides information about your plan and who to call if you have questions. You should also receive a booklet from the insurer or from your human resources department that describes all the details of your insurance plan. Insurance companies work with pharmacy benefit managers, also known as PBMs, to manage prescription drug benefits. PBMs decide which drugs are covered by your plan, your share of a drug's cost, and whether you must meet certain restrictions before you can receive a drug. Your PBM should also be listed on your insurance card with contact information. It may say something like prescription customer service. Call that number for questions about prescription drug costs and coverage. Some employers have contracts with outside companies to help employees understand and access their health insurance benefits. These companies can be very useful to employees with complicated medical conditions. Your human resources department can tell you whether your company has such an arrangement, and if so, how you can use their services. Now we're going to move on to some key terms: premiums and deductibles. Now, patients are responsible for different types of out-of-pocket costs. I'm going to walk you through the different types of costs you have for your health care. Premiums are the monthly fee you pay to have health insurance coverage. If you have insurance through your employer, you probably share this cost with them. A deductible is the amount of money you must pay for services and prescriptions each year before your insurance starts to pay a portion of those costs. If you have a high deductible health plan, the deductible will be at least $1,500 for an individual or $3,000 for a family plan. Other types of plans generally have lower deductibles. It's important to know that some preventive services and prescriptions must be covered at no cost to you even before you meet your deductible. Your plan documents can tell you which services those are. A copayment, also called a copay, is the set amount you pay for services or prescriptions. Copays are different amounts for different services or drugs. For example, a generic drug may have a $10 copay, while a brand name drug may cost you $30. Likewise, you may have a $15 copayment to see your primary care doctor, but have to pay $40 to see a specialist. Every plan is different. Coinsurance is an amount you pay for a service or prescription that is based on a percentage of the cost rather than a fixed amount. For example, if a particular drug costs $100 and your coinsurance is 20%, you would have to pay $20 out of pocket. If your drug costs $1,000, your share of the cost would be $200. Many plans use both copayments and coinsurance. If you can, choose a plan that uses copays rather than coinsurance. Coinsurance fees can be very high since they're based on a percentage of the service or drug cost. The out-of-pocket maximum is, as it sounds, the maximum amount you have to pay for covered in-network services during your plan year. After you reach your out-of-pocket maximum, your insurance pays everything else. Now, it's important to stress that only covered services provided in-network count towards your out-of-pocket maximum. And some insurance companies have policies that don't count payments made by others on your behalf, such as pharmacy coupons or other financial assistance toward that out-of-pocket maximum. We'll talk more about that during our second webinar. Now, the federal government sets a limit on how high the out-of-pocket maximum can be every year. In 2023, the out-of-pocket limit for most health insurance plans can't be more than $9,100 for an individual and $18,200 for a family. For high deductible health plans, the out-of-pocket maximums are lower, $7,500 for an individual and $15,000 for a family. There are many different types of health insurance plans, and it seems like every plan differs with different benefits and different costs. When you're choosing a plan, it's important to look at all the benefits and costs before making your selection. I'll describe the most common types of plans. HMO is short for Health Maintenance Organization. Under an HMO, all your care is coordinated by a primary care doctor, and you can only receive services from doctors and other providers who are part of that system, except in emergencies. It's a closed system since all your clinicians work for one company. HMOs are often affordable healthcare options, but they do limit your choices of physicians and services. Under a PPO, which stands for Participating Provider Organization, you get to decide which doctors to see and where you want to receive your services. In many cases, you don't even need a referral to see a specialist. Now, your insurance company will have an arrangement with a network of preferred providers, and if you use those doctors and facilities, you will have much lower costs. It's important to check with doctors and hospitals whether they are part of your insurer's PPO network before you receive your services. Remember that term, in-network. It's really important for controlling your healthcare costs. A point of service or POS plan is very similar to a PPO plan, except that you must usually get a referral from your primary care physician if you want to see a specialist. Like a PPO, you can save money by seeing doctors and using services within your insurer's network. HDHPs are high deductible health plans, which means that you must pay at least $1,500 for an individual or $3,000 for a family plan for covered services before your insurance company starts paying a percentage of your costs. Now, that $1,500 deductible is a minimum. Many HDHP plans have much higher deductibles. HDHPs have become very popular because the insurance premiums, again, that's the monthly amount you pay just to have insurance, is usually much lower than the premiums for PPO and POS plans. HDHPs can be a good option for younger, healthy people, but they can create problems for people with chronic conditions or those who use a lot of healthcare services, because you're going to need to pay a lot out of pocket before your insurance kicks in. There are some preventive and other services that HDHP plans are allowed to pay for before the deductible is met. These include routine screenings, some blood work and tests, well baby, well child, and annual wellness visits. HDHPs may also cover treatments for chronic conditions such as congestive heart failure, diabetes, hypertension, asthma, liver disease, and depression on a pre-deductible basis. But again, they don't have to do that, so you need to read the fine print before you sign up. Every HDHP plan is different. It's important to know what the amount of the deductible is and what the plan covers on a pre-deductible basis before you choose that plan. You'll also want to ask if the plan is eligible for an HSA or health savings account. An HSA or health savings account is a special type of personal savings account that you can set up to pay certain healthcare costs like deductibles, co-payments, co-insurance, and other qualified expenses such as hearing aids or acupuncture. An HSA allows people to put money away on a pre-tax basis and withdraw it tax-free as long as it's used for qualified medical expenses. The money in the account never expires, it rolls over from year to year, and it still belongs to the account owner, even if they change to a different type of health insurance plan. Now, you can only contribute to an HSA if you're covered by certain high deductible health plans. You cannot contribute to an HSA if you have Medicare coverage or a non-high deductible health plan like a PPO or a POS. If you choose an HDHP plan, try to select one that is HSA qualified and do set up and contribute to your savings account. It will save you a lot of money over time. The drug formulary, also called a drug list, is the list of drugs that your insurance plan covers. Drugs are arranged into tiers that have different out-of-pocket costs. Generic drugs are usually placed on the lowest, which is the least expensive tier, while brand name drugs are usually placed on higher, more expensive tiers. Now, the formulary is created by your PBM. Remember, that's the pharmacy benefit manager, and it can change over time. PBMs negotiate directly with drug companies and decide which drugs to include on their formularies based on those negotiations. Most formularies are closed, which means they do not include every drug approved by the Federal Drug Administration, or the FDA. This means that the formulary may cover only one or a few drugs available to treat a certain condition. If a drug isn't on the formulary, your doctor may prescribe a different drug for you. Occasionally, your doctor may think you need a drug that isn't on the formulary and ask your PBM to make an exception. It can happen, but it's rare. Now, your PBM is required to publish a list of all the drugs on its formulary, as well as the drugs that it excludes. Those are the drugs it won't pay for you. If you have a chronic condition and take a certain drug on a regular basis, you should be sure to check the formulary and exclusions list before you choose a plan. And again, during your annual open season for the next year's plan. Although PBMs can change their formularies in the middle of a plan year, it's best to start the year knowing that the plan is going to be covering your medication, at least for that period of time. Utilization management, also known as is an umbrella term for rules that insurance companies use to control access to certain types of treatments and prescription drugs. They save money by determining whether healthcare services are medically necessary and appropriate for patients before the patient can receive them. Now, can help to prevent unproven or unnecessary treatments and reduce costs while still allowing patients to receive quality care. Unfortunately, can also delay or deny necessary care, create extra work for doctors and their staffs, and frustrate the patient trying to access treatments. Insurance companies use several different techniques to control costs. In our next webinar, we'll explain the utilization management techniques that I'm listing here and what you as patients need to understand about them. We hope that this information provided in the webinar has been helpful and that you'll watch our second webinar in the series. You can also find more information about utilization management and insurance plans on the Cancer Care website, or visit www.cancercare.org. betterrxbenefits.org. Thank you for joining me.